I really want to welcome you, the listener, into the room with us today because, we always call you the learner around here since you show up wanting to really understand the forces shaping the world. And today,
Mm,
we have something custom tailored for that exact curiosity.
we really do. It's a massive topic.
It is. And I want you to imagine, just for a second, being locked in a very specific room. The heavy wooden doors are closed. The air is incredibly stale, maybe smelling faintly of like old coffee and just high anxiety.
Oh yeah, the stress in that room would have been unbelievable.
Right. It is late at night on a weekend in the fall of 2008, and sitting around you are some of the most powerful financial minds on the planet, and they are looking at data that is telling them this impossible story.
A truly terrifying story, honestly.
Yeah, the data says the entire global economy. I mean, the vast invisible machinery that powers the grocery stores in your neighborhood, your gas station, your employer's payroll, it's on the absolute brink of total catastrophic collapse.
They were quite literally staring into the abyss, and the
Yeah.
abyss was staring right back at them.
Exactly. And the only thing standing in the way of a modern dark age is this exhausted group of central bankers armed with whiteboards, some obscure legal statutes from the 1930s, and a very deep understanding of financial history.
You know, that image feels almost cinematic, but I promise you it is not an exaggeration of the stakes.
Yeah.
That was the visceral, terrifying reality for the leadership of the Federal Reserve during the 2008 financial crisis.
Because the system was completely seizing up, right?
It was. And the tools they ultimately deployed to pull the global economy back from that ledge, they weren't just invented on the spot over weekend panic.
They didn't just pull them out of thin air.
No, not at all. They were the culmination of a century of brutal, hard-learned lessons, catastrophic historical failures, and just a constantly evolving understanding of human psychology in the face of sheer panic.
And we have an incredible foundation for decoding all of this today. We're looking at a masterclass, really. It's a synthesis of 4 historic lectures delivered at George Washington University by Ben Bernanke.
The former chairman of the Federal Reserve himself.
Yeah, the man who was actually at the head of that table in 2008, steering the ship through the worst financial storm since the Great Depression. The source compilation is called The Federal Reserve and the Financial Crisis.
It's phenomenal material.
It really is. And our mission today for this deep dive is not just to do a dry post-mortem on 2008. We want to decode the very DNA of central banking.
Right, because you have to look at how early failures in, like, the 1930s and 1970s taught these crucial lessons.
Exactly. And we're going to uncover how this seemingly invisible, incredibly complex financial machinery actually impacts your everyday life. We're talking about the mechanisms that dictate your mortgage rates, the security of your job, and, the purchasing power of the dollar sitting in your wallet right now.
It is so easy to dismiss central banking as this dry academic subject or something that only matters to Wall Street traders shouting on a trading floor.
Oh, for sure. It feels very disconnected from normal life.
But understanding these levers,
Mm.
interest rates, liquidity, the money supply, it provides you with a genuine superpower. It really does.
How so? Like, what does it give the average person?
Well, it allows you to read financial headlines and actually understand the subtext, the mechanics beneath the panic or the euphoria. It helps you anticipate economic cycles rather than just reacting to them with fear. It demystifies the forces that shape your personal financial reality.
Okay, let's unpack this, because if we are going to truly grasp how Bernanke fought the crisis in 2008, we can't just start in 2008. We have to start at the very foundation, the blueprint of central banking.
We have to examine the fundamental vulnerability of finance itself, the Achilles heel of the entire system.
And that vulnerability is liquidity risk.
Right. Before we ever had modern electronic trading or, before derivatives and algorithmic stock apps on your phone, there was this core, unavoidable risk built into the very concept of banking.
Bernanke takes us back to the classic 19th century community bank to illustrate this, doesn't he?
Yeah, he does. So picture a local bank in a small town. The citizens deposit their cash there. And the bank promises, whether implicitly or explicitly, that you can walk in and withdraw your cash whenever you want.
Just walk up to the teller and get your money.
Exactly.
Yeah.
But the bank doesn't just lock your physical money in a steel vault and leave it there gathering dust.
Because if they did that, they couldn't pay you any interest on your savings, and
Yeah.
they certainly wouldn't make a profit to keep their own lights on. So they utilize a system called fractional reserve banking.
Right.
I always think of it like a modern gym membership. Imagine a local gym that sells 1,000 memberships to people in a neighborhood. The owner does the math and knows that on any given Tuesday evening, only maybe 50 people are actually going to show up to work out.
That's a great analogy, actually.
So they only buy 50 treadmills. It's a highly efficient allocation of resources. It works flawlessly day in and day out. But then January 1st rolls around.
Oh, the New Year's resolution crowd.
Exactly. Every single person makes a resolution, and all 1,000 members show up at the exact same time demanding a treadmill. The gym physically cannot handle it. The system just breaks.
Yeah, the gym is suddenly facing an acute liquidity crisis. In banking terms, the bank takes those initial deposits and lends the vast majority of them out into the community.
Right. They aren't just sitting on cash.
No, they lend to local businesses, to build factories, to farmers buying heavy equipment, to families buying homes. And crucially, these are long-term loans. You pay a mortgage back over 30 years.
Right.
So the bank only keeps a tiny fraction of the original deposits on hand as liquid cash reserves in the vault, just like your gym only keeping 50 treadmills for 1,000 members.
And during normal, calm times, the math holds up beautifully.
It does. But if a rumor starts, maybe someone here, the bank made a massive, terrible loan to a railroad company that just went bankrupt.
Yeah.
Panic sets in. Depositors rush to the bank to pull their money out before the vault runs dry.
Because no one wants to be the last person in line when the teller pulls the window shade down and says, sorry, the money is gone.
Exactly. And this leads to a critical distinction that is absolutely essential for understanding not just 19th century panics, but the 2008 crisis itself.
This is huge, the difference between being solvent and being illiquid.
Yes, the massive difference. A bank can be perfectly solvent. That means if you take all of its assets, all those long-term loans it made to farmers and businesses, which are fundamentally good loans that will absolutely be paid back over the next 10 or 20 years, and you subtract its liabilities, the bank is in the green.
Its assets exceed its liabilities.
Right. However, that same fundamentally healthy solvent bank can become acutely illiquid in a matter of hours.
Because it can't just magically, instantly convert a 30-year farm mortgage into cold, hard cash to hand to a panicked depositor standing in the lobby.
Yeah, exactly. So a perfectly healthy institution can be driven into immediate bankruptcy simply because it faces a short-term liquidity shortage.
And what makes this dynamic so terrifying is that the fear doesn't exist in a vacuum. It is deeply, dangerously contagious.
It spreads like wildfire.
When you look back at the 19th century in America, it was just a relentless roller coaster of financial panics. 1873, 1893, and 1907. You have this scenario where one bank faces a run, the depositors are lined up down the street, and regular people walking by see it.
They see the line and panic.
Right. They might not even know why there's a run on that specific bank, but they immediately think, wait, is my money safe at my bank across the street? So they go and withdraw their money just to be safe.
And that collective panic spreads from town to town, entirely freezing credit across entire regions of the country. The contagion of fear completely paralyzes the real economy.
Because businesses can't get cash.
Right. When credit freezes, businesses can't make payroll, farmers can't buy seed for the next harvest, merchants can't stock their shelves. It is devastating to everyday life.
So in response to these recurrent systemic nightmares in the 19th century, economic thinkers began to theorize a structural solution, which brings us to a prominent British economic writer named Walter Bagehot.
Bagehot is practically a mythological figure in central banking circles.
He really is.
Yeah.
He articulated the golden rule for what we now call the lender of last resort.
He looked at these irrational panics and realized that you need a central, unquestionable institution that can step in when the panic hits and the normal market mechanisms fail.
And he formulated a very specific set of rules for how a central bank should act during a crisis to stop the contagion.
The rules are surprisingly simple but profound. First, lend freely. Second, lend only to solvent institutions. Third, lend against sound collateral. And fourth, lend at a penalty interest rate.
Okay, wait, I have to pause you there and push back on that last point, because the penalty rate concept has always felt incredibly counterintuitive to me, almost punitive.
It does seem harsh.
Right, like if a bank is bleeding cash, depositors are screaming in the lobby, and the institution is fighting for its very survival, why on earth would the central bank, the supposed savior, charge them a penalty interest rate? Isn't that just kicking them when they are down? Seems like you're ensuring their failure by making the rescue too expensive.
It absolutely seems harsh on the surface,
Yeah.
but it is a vital, load-bearing pillar of the entire system. This touches on a deeply ingrained concept in economics called moral hazard.
Moral hazard. Unpack that for us.
We have to think about human behavior and incentives over the long term. If the central bank acts as a permanent, consequence-free safety net and hands out cheap, easy money whenever a bank gets into trouble, the banks will adapt their behavior.
They'll just take more risks.
Exactly. They will start taking massive, reckless risks, operating with practically zero cash reserves, knowing they will just get bailed out on the cheap if things go wrong.
Oh, I see.
By charging a penalty rate, a rate significantly higher than normal, everyday market rates, the central bank ensures that banks only come to them in a genuine, desperate emergency. It makes borrowing from the central bank painful.
They're throwing you a life preserver, but they're going to make it hurt your profit margins so severely that you don't make a habit of needing to be saved.
That's a perfect way to put it.
Yeah.
This protects the everyday taxpayer from indefinitely subsidizing reckless banking behavior.
So it's heavily engineered fiction. It makes me think of like an emergency room copay in a healthcare system.
Oh, that's a brilliant comparison.
You are incredibly grateful the hospital is there to save your life when you're having a heart attack, but the bill is going to be high enough that you aren't going to go to the ER every time you get a paper cut. You'll manage your own minor risks.
That captures the dynamic perfectly.
Yeah.
And, lending against sound collateral ensures the taxpayer is protected if the bank ultimately fails anyway, despite the loan. And by lending freely to solvent institutions, the central bank breaks the psychological fever of the panic. If depositors know the bank has access to unlimited emergency cash from the central bank to meet withdrawals, the panic simply evaporates.
They realize their money is safe, they go home, and the bank doesn't even need to borrow the money anymore.
Exactly. The mere existence of the credible backstop solves the problem.
And this realization, this desperate need for a badge-hot-style lender of last resort became painfully obvious in America after the particularly brutal panic of 1907.
Oh, 1907 was a nightmare.
It was so severe, it required J.P. Morgan, a private citizen, to literally lock the most powerful bankers in New York inside his private library until they agreed to pool their money and bail out the system.
He basically forced them to act as a central bank.
Yeah, and the government realized they couldn't rely on one rich guy to save the economy every 10 years. That directly led to President Woodrow Wilson signing the Federal Reserve Act in 1913.
The Fed was born.
They had the blueprint. They had Bagehot's rules. Problem solved. We have a central bank now, so the economy is permanently safe, right?
If only the real world operated that smoothly.
Yeah, clearly not.
As Bernanke points out repeatedly in his lectures, establishing the legal framework of a central bank is the easy part. Operating it correctly, having the analytical clarity to understand what is happening in real time, and possessing the institutional courage to use those tools during a historic, unprecedented crisis that is an entirely different, incredibly difficult challenge.
The blueprint alone doesn't build the house. And it certainly doesn't put out the fire if you refuse to turn on the water.
Exactly.
Which shifts us directly into the original sins of the Federal Reserve. Establishing the bank was one thing, but their actions during the Great Depression of the 1930s showed a catastrophic failure to apply those tools.
Total failure.
The grim statistics post-1929 stock market crash are almost unfathomable today. Thousands of community banks just vanished overnight. The life savings of entire generations gone in an instant. Unemployment hit 25%.
1 in 4 working adults had no job and no prospect of getting one.
And the national economic output plunged by a third. Bernanke, who dedicated much of his academic life to studying this specific period, doesn't just say the Fed failed to stop the Depression. He argues their specific policy errors actively, aggressively made it worse.
He views the Great Depression as a horrifying masterclass in what happens when central bankers fail to execute their core duties.
Right.
Bernanke identifies 2 fatal policy errors. The first was the Fed's complete baffling failure to act as that lender of last resort we just discussed.
Yeah.
Bagehot explicitly said lend freely. But when the panic hit the banking system in the early 1930s, the Federal Reserve largely stood by passively.
They just watched thousands of banks collapse under the weight of bank runs. But why? I find this so hard to understand. They had the mandate, they had the blueprint. Why did they just watch it burn?
Because the leadership was operating under a deeply flawed, rigid economic philosophy prevalent at the time, known as the Real Bills Doctrine.
The Real Bills Doctrine. Okay.
The leaders of the Fed look back at the 1920s, the Roaring '20s, and saw an era of massive speculative excess, stock market bubbles, and reckless borrowing. They weren't entirely wrong about that excess, but they mistakenly believed that the collapse of these banks was a necessary, even healthy, purging of that speculative disease from the system.
So they thought it was good.
They thought the market needed to be violently liquidated to get back to a baseline of reality. They viewed the pain as a moral and economic necessity.
They viewed it as a moral necessity. That just sounds like a Forest Service deciding to let a small brush fire burn because they want to clear out the deadwood. But they just stand there shrugging their shoulders while the fire rages out of control and burns down all the healthy ancient redwood trees too.
That's a hauntingly accurate way to put it.
You are actively destroying the very ecosystem you are supposed to protect because you are blinded by a rigid doctrine.
And by allowing fundamentally sound solvent banks to fail just because they lacked immediate cash, the Fed allowed the total money supply in the United States to shrink by roughly 1/3. That is a staggering contraction. When you pull that much money out of the economy, you trigger severe monetary deflation. Prices collapse.
Which sounds good for consumers initially, right? Cheaper goods.
Right, but businesses quickly realize they can't sell their goods for what it costs to make them. So they go bankrupt, they fire their workers, the unemployed workers have no money to spend, which causes more businesses to fail, and the downward spiral accelerates into a depression.
And if that catastrophic inaction wasn't bad enough, Bernanke points out their second fatal error, which was an active policy choice, their religious adherence to the international gold standard.
Right, the gold standard. Under this system, the value of the U.S. dollar was strictly legally tied to a fixed amount of physical gold held in government vaults.
Okay.
In the early 1930s, as the banking panic spread globally, foreign investors started getting extremely nervous about the health of the U.S. economy. They began exchanging their paper dollars for physical gold and pulling that gold out of the United States, draining the reserves.
And to stop them from draining the gold, the Fed did something that, in hindsight, seems like absolute economic suicide. They raised interest rates.
Yes, they did.
In the middle of a massive economic depression, with a quarter of the country out of work, they made borrowing more expensive.
Under the strict mathematical logic of the gold standard, they felt they had no other choice. By raising interest rates, they made it more attractive for foreign investors to keep their capital in U.S. dollar-denominated assets rather than converting it to gold. It was a desperate defense of the currency peg.
But what happens to the domestic economy when you raise borrowing costs during a depression?
It's devastating. You completely crush whatever remaining consumer spending exists. You make survival borrowing impossible for struggling businesses. You accelerate the very deflationary spiral that is tearing the country apart.
Bernanke makes a fascinating point in the source material comparing different countries during this era. He notes that if you look globally, the countries that abandoned the gold standard early, like Great Britain, actually recovered from the Great Depression much faster.
They unshackled themselves.
Exactly. They unshackled themselves and allowed their central banks to expand the money supply. Whereas the countries that clung to gold out of ideological purity, like the US and France, suffered far longer and far deeper. It's a tragic testament to the dangers of being bound to a rigid ideological system when reality demands flexibility.
These painful lessons from the 1930s completely shaped Bernanke's worldview decades later. He understood deeply that inaction is a choice, and a highly destructive one.
Right.
These historical failures eventually led to a major legislative shift after World War II. Congress passed the Employment Act of 1946 and later the Humphrey-Hawkins Act of 1978. These laws fundamentally changed the Fed's mission, giving them what we now call the dual mandate.
The dual mandate.
Yes. No longer was the Fed just a lender of last resort or a mechanical guardian of the currency peg. They were legally mandated by Congress to proactively pursue two primary, often conflicting goals: maximum employment and stable prices.
Okay, so let's fast forward a few decades with that dual mandate in mind. We move into the 1970s, and the Fed faces a completely different monster, the Great Inflation.
A totally different kind of crisis.
For anyone listening who didn't live through it or hasn't studied it, the 1970s were an economically miserable decade. You had Middle Eastern oil embargoes sending the price of a gallon of gas to the moon, causing lines blocks long.
Just massive energy shocks.
You had inflation climbing over 14%. And you had this nightmare scenario called stagflation, which is stagnant economic growth combined with high inflation. It's the worst of both worlds.
It really is.
Things cost significantly more every month, but you aren't making more money, and the economy isn't growing to create new opportunities.
Once again, Bernanke points out that this misery was largely driven by monetary policy errors, though of a completely different flavor than the 1930s. In the 1970s, Fed officials consistently underestimated the long-term corrosive dangers of inflation.
They lean too hard into the maximum employment side of their mandate, right?
Exactly. They believed that they could tolerate a little more inflation if it meant keeping unemployment artificially low. But what they failed to realize is that inflation is largely a psychological phenomenon. They allowed inflation expectations to become what economists call unanchored.
Unanchored, meaning the general public stopped believing the Fed had the willingness or the ability to control prices.
Think about it from a human perspective. If you, as a consumer and a worker, expect that prices are going to rise by 10% next year, what do you do today?
I go to my boss and demand a 10% wage increase just to break even, just to maintain my standard of living.
Right. And your boss agrees because they want to keep their workers. But now their labor costs are 10% higher. So they raise the prices of the goods they sell by 10% to cover the cost.
Which proves my initial expectation correct, leading me to demand another raise the following year.
Yes. It becomes a self-fulfilling, self-sustaining behavioral spiral. Once the psychology of expectations becomes unanchored, the central bank has lost control of the economy.
So how do you break a self-fulfilling psychological spiral like that? Because that seems impossible.
It requires extreme measures. And the answer arrived in the form of Paul Volcker in 1979, appointed by President Jimmy Carter.
Ah, the Volcker shock.
Exactly. Volcker comes into the Fed and basically decides to administer the most brutal economic medicine possible.
What did he do?
He understood that the only way to restore the long-term health of the economy was to break the back of those inflation expectations, and that required restoring the Federal Reserve's credibility at any cost. He had to prove to the American public and the global markets that the Fed was willing to do whatever it took to stop inflation, no matter how much short-term pain it cost.
And he did it by raising rates.
Oh, he raised the benchmark federal funds rate to unprecedented eye-watering levels. He pushed short-term interest rates near 20%.
20%. I want the listener to really internalize that number. Imagine logging into your bank account right now, or opening a letter from your mortgage lender and seeing your credit card rate, your auto loan, or your mortgage jump to 20%.
It's almost unthinkable today.
That wasn't a hypothetical model. That was the visceral reality for the American middle class. It deliberately stopped the economy dead in its tracks. Volcker intentionally triggered two sharp, brutal recessions in the early 1980s.
Unemployment skyrocketed above 10%.
The political and public backlash was immense. I read that home builders were mailing him 2x4s. People were sending him their car keys in the mail because they couldn't afford their auto loans anymore.
It was a brutal prescription, and the human cost was very real. But if we connect this to the bigger picture of macroeconomic stability, it worked.
It actually worked.
It did. Volcker successfully dragged inflation down from over 14% to under 4%. More importantly, he successfully re-anchored those psychological expectations. He proved, through sheer force of will, that price stability is an absolute, non-negotiable prerequisite for long-term economic health.
Because you simply cannot have a functioning, growing economy if the currency is rapidly degrading and no one can plan for the future.
Right. The Volcker shock laid the stable foundation for the next few decades of economic growth.
So the fever breaks because Volcker took the hit. And this ushers in a long golden era of economic calm. But in studying financial history, you quickly realize that prolonged calm is often just the gestation period for the next massive crisis.
That is one of the most profound cyclical paradoxes in economics, often associated with the economist Hyman Minsky. Stability breeds instability.
Stability breeds instability.
The era we are talking about, stretching from the mid-1980s up until 2007, is broadly known as the Great Moderation. Under the leadership of Fed Chairman Alan Greenspan, the U.S. economy enjoyed this incredible, unprecedented run. Steady expansion, very low unemployment, consistently low and predictable inflation.
The recessions we did have were brief and relatively shallow. People in academia and on Wall Street started to believe that the central bankers had become wizards who had finally tamed the business cycle for good. They thought they had solved economics.
The end of history for the business cycle. But underneath that incredibly calm surface, something deeply dangerous was mutating.
Here's where it gets really interesting.
The source material highlights that when an economic environment feels completely risk-free for a long period, complacency sets in like a rot. Investors, massive banks, government regulators, everyone collectively lets their guard down.
Think about it from an investor's perspective. If you are managing a pension fund and the safe investments like government bonds aren't paying a high yield because interest rates are low and stable, you start desperately chasing higher yields to meet your targets.
Right, and to get higher yields, you have to take on more risk. You usually do it by using massive amounts of leveraged borrowed money to amplify small returns.
And the arena where this toxic combination of complacency, desperate yield chasing, and massive leverage manifested most aggressively was the U.S. housing market.
Yes.
Historically, mortgage lending was a fundamentally conservative, almost boring business. If you wanted to buy a house, you went to your local bank. You needed a 20% cash down payment. You had to provide a mountain of documentation to verify your income, your employment history, your tax returns, your credit score.
The banks scrutinized you heavily because they were going to hold that specific loan on their own books for the next 30 years. If you defaulted, the bank took the loss directly. They had skin in the game.
But during the Great Moderation, especially ramping up in the early 2000s, that entire underwriting discipline just evaporated. Lenders shifted from that conservative model to what we now call subprime lending.
They started actively, aggressively offering mortgages to borrowers with poor credit histories, low income, and sometimes literally zero savings.
They created these exotic predatory products. You had interest-only loans where you weren't even paying down the principal. You had adjustable rate mortgages or ARMs where the initial interest rate was a tiny teaser rate that would legally explode much higher a few years down the line, essentially guaranteeing the borrower couldn't afford it.
And you even had no-doc loans, famously called NINJA loans in the industry. No income, no job, no assets. You just walked in, verbally stated an income, and they handed you a $500,000 mortgage.
It defies basic logic until you understand the underlying collective assumption that had infected the entire market psychology. Lenders, borrowers, Wall Street investors, and rating agencies all believed one core, unshakable tenet. National home prices will rise forever.
Right. If home prices never fall, then a bad loan isn't actually risky. If a borrower with no income defaults on their mortgage in 6 months, the lender doesn't care. They just foreclose on the house, sell it in a booming market for a profit, and everyone walks away happy.
The rising tide covered all the rot. But there is a second, even more insidious reason the lender sitting across the desk having you sign those papers didn't care if you could pay them back. And this is the great disconnect of modern finance. That mortgage originator wasn't keeping your loan. They were packaging it up and selling it up the chain almost immediately.
The originate-to-distribute model. And this introduces us to a massive, complex ecosystem that defines the structural reality of the 2008 crisis, the shadow banking system.
Shadow banking. When most of us think of banks, we think of the place with the ATMs, the tellers, and the little FDIC sticker on the glass door.
Right, the traditional commercial bank.
And that FDIC insurance means if the bank goes under, the federal government guarantees your deposits up to a certain amount. That guarantee prevents you from panicking and starting a 19th century bank run. But this shadow banking system operates in a totally different universe.
What's fascinating and terrifying here is how much of the global financial plumbing had migrated completely away from traditional, heavily regulated, FDIC-insured commercial banks. The shadow banking system was made up of investment banks like Lehman Brothers and Bear Stearns, massive independent mortgage companies, hedge funds, and money market mutual funds.
So they didn't take retail deposits from everyday citizens.
No, they didn't. So they didn't have FDIC insurance, and they weren't regulated like traditional banks, but they still needed massive, astronomical amounts of cash on a daily basis to fund their operations and buy assets.
I was reading the source material trying to wrap my head around the mechanics of this. If they don't have mom-and-pop deposits, how are these shadow banks funding trillions of dollars in assets?
They relied on a mechanism called short-term wholesale funding, specifically the repo market repurchase agreements.
Okay, let's break down how this plumbing actually works.
Imagine a massive investment bank that wants to hold $50 billion in long-term assets on its balance sheet. To pay for those assets, they borrow cash overnight from large institutional investors or money market funds. The investment bank hands over financial securities as collateral and promises to buy them back the very next day at a very slight premium, which represents the interest rate.
So every single day, the executives at this bank have to wake up and successfully roll over tens of billions of dollars in overnight loans just to survive until tomorrow.
Exactly. They were funding long-term, highly illiquid assets with extremely short-term overnight borrowing.
The structural vulnerability of that is staggering. It's like funding a 30-year mortgage on your family home by putting it on a credit card. that you have to renegotiate every single morning over breakfast with a stranger.
Huh, yes.
If one morning the credit card company looks at you and says, "No, we don't trust you today," you lose the house by lunch.
That is the exact vulnerability, perfectly stated. And what were these long-term assets they were buying with all this fragile overnight cash? They were the end products of the securitization machine. Those toxic, no-doc subprime mortgages we discussed, the investment banks bought them by the thousands.
The great alchemy of Wall Street.
It felt like alchemy to them. They bundled them together into complex financial instruments called mortgage-backed securities, or MBS.
They took thousands of risky loans, bundled them, and then sliced and diced those bundles into even more complex, opaque structures called collateralized debt obligations, or CDOs.
Right. They created tranches of risk, theoretically isolating the worst mortgages at the bottom, while claiming the top layers were completely insulated from default.
I have to stop here, because this is the systemic failure that always boggles my mind. How on earth were the rating agencies, the Moody's, the Standard & Poor's, the institutions whose entire existence is based on evaluating risk looking at these CDOs, which were essentially towering Jenga blocks of toxic, no-doc, subprime mortgages, and stamping them with AAA ratings?
It's hard to believe now.
A AAA rating means the asset is considered as safe as a U.S. Treasury bond. It implies practically zero risk of default. How did that systemic failure of risk assessment happen on such a massive scale?
It was a profound failure of imagination, deeply rooted in the illusion of diversification and flawed historical models.
The models were wrong.
Completely wrong. The rating agencies built their mathematical models using historical data entirely from that great moderation period we talked about, a period of exceptional calm. Their models effectively said, well, the housing market in Florida might go down, but the housing market in Nevada won't crash at the exact same time.
So they thought spreading it out made it safe.
Right. They believed that by bundling thousands of mortgages from all over the country together, the geographic diversification mathematically eliminated the risk. They fundamentally failed to foresee a scenario where home prices across the entire nation declined simultaneously. Their models just didn't include the variable of a correlated national housing crash.
So you have a completely unregulated shadow banking system, heavily reliant on daily, overnight borrowing just to keep the lights on, holding trillions of dollars in CDOs that everyone falsely believes are perfectly safe, but are actually built on a rotting foundation of mortgages that borrowers fundamentally cannot afford.
A recipe for disaster.
You can see the train coming miles down the track. In 2006, housing prices peaked and finally began to fall. Those adjustable rate mortgages reset, the teaser rates ended, and subprime borrowers started defaulting in massive, unprecedented numbers.
And suddenly the music stopped. Those complex mortgage-backed securities began plunging in value.
But the total dollar amount of the actual subprime mortgage losses was technically manageable, wasn't it?
It was, yeah. In the grand scheme of global finance, it wasn't large enough to destroy the world on its own. But the crisis wasn't just about the size of the losses. It was about uncertainty and the destruction of trust. Because these CDOs were so complex and had been sold and resold globally, no one knew who held the toxic assets. They were buried deep on balance sheets all over the world.
It's like finding out someone at a crowded party has a highly contagious, lethal virus, but you don't know who, you don't trust the person next to you, you don't trust the host, so you just run out the door as fast as you can.
Trust vanished from the financial system overnight. So in the summer of 2007, those overnight repo lenders, the money market funds who supply the daily oxygen of cash, woke up and looked at the investment banks. They said, we don't know if the collateral you're handing us today is backed by worthless subprime debt. We don't trust you. We are not rolling over your loan today. And instantly, the entire shadow banking system faced total liquidity starvation. It was a classic badge-hot-style 19th century bank run, but instead of panicked citizens lining up outside a brick-and-mortar bank on Main Street, it was institutional investors quietly refusing to roll over overnight loans on computer screens. The mechanism was different, but the panic was identical.
This brings us to the absolute meltdown. It is late 2007, heading into the meat grinder of 2008. The dominoes are wobbling violently, and Ben Bernanke, sitting in the chairman's seat at the Fed, is suddenly staring at the exact liquidity panic he studied as an academic looking at the 1930s.
History repeating itself.
But it isn't a bunch of farmers and merchants. It's happening in this invisible, hyper-connected, globalized shadow banking system. The stakes are unimaginably higher, and the speed is terrifying.
The central bank had to act to stop the contagion. Initially, they tried their traditional textbook tools, The Fed's main weapon is the federal funds rate, which influences short-term interest rates across the broader economy.
So they started slashing it.
They did. They cut it from 5.25% down, until it was practically zero. But it didn't work. The credit markets remained completely paralyzed.
Why didn't it work? If money is essentially free, why wouldn't they lend?
Because you can make the cost of borrowing as cheap as you want. But if banks are absolutely terrified that the bank across the street is insolvent and hiding toxic assets, they will not lend to them at any price.
The traditional plumbing of the financial system was completely broken. Lowering the water pressure doesn't help if the pipes have exploded.
Exactly. So Bernanke and his team had to get incredibly creative, and they had to do it within the bounds of the law. They went into the archives and resurrected Section 13(3) of the Federal Reserve Act.
Section 13(3), what is that?
This was an obscure provision written during the Great Depression for, quote, unusual and exigent circumstances. It gave the Fed the emergency authority to lend outside of traditional commercial banks. They could lend directly to corporations, partnerships, you name it, if the emergency was severe enough to threaten the broader economy.
And this broad authority led to the rapid creation of a massive array of emergency lending facilities. It became an alphabet soup of programs, each designed to target very specific, clogged arteries in the financial plumbing.
Let's look at a few of them. For example, they created the CPFF, the Commercial Paper Funding Facility. Many large, fundamentally healthy corporations, think of companies making cars or household goods, rely on issuing short-term debt called commercial paper just to make their weekly payroll and buy inventory.
Okay.
When the panic hit, investors were so scared they wouldn't even buy that safe debt. Healthy companies were weeks away from firing their workers, not because their businesses were failing, but because the credit market was frozen solid.
So the Fed stepped in under 13(3) as the buyer of last resort for commercial paper, ensuring payrolls were met.
Precisely. There was also the AMLF, the Asset-Backed Commercial Paper Money Market Mutual Fund Liquidity Facility.
Wow, that one is a mouthful.
It is, yeah. That was explicitly created to stop the runs on money market funds, which is where everyday people, pension funds, and businesses keep their short-term cash, assuming it's perfectly safe. They also set up the PDCF, the Primary Dealer Credit Facility, to provide emergency liquidity directly to the big Wall Street broker-dealers who were cut off from the repo market.
And we have to emphasize that this wasn't just an American crisis. European and Asian banks had eagerly bought up these toxic U.S. mortgage products, too.
Yes, the global dimension is crucial here. Those foreign banks had bought dollar-denominated assets, which meant they desperately needed U.S. dollars to service their daily debts. When the crisis hit, they couldn't get dollars anywhere.
So what did the Fed do about the global shortage?
That global dollar shortage could have caused the entire international financial system to seize up. So the Fed established immense liquidity swap lines with major foreign central banks. The European Central Bank, the Bank of Japan, the Bank of England. The Fed essentially traded billions of dollars for foreign currency, allowing those foreign central banks to distribute the dollars to the struggling banks in their own jurisdictions.
It was a massive, unprecedented deployment of the lender of last resort function on a truly global scale.
Unprecedented is the right word.
But despite all these broad, systemic liquidity programs flooding the system with cash, the fire was still raging, and it was threatening to bring down specific, massive institutions, the too-big-to-fail giants. Let's look at the three mega dominoes of 2008, because this is where the historical drama really hits its peak. From March to September 2008, the first domino to fall was Bear Stearns.
Bear Stearns was a major Wall Street investment bank, deeply entangled in the shadow banking system, heavily reliant on daily repo funding, and loaded to the brim with toxic mortgage assets. In March 2008, the repo market completely cut them off. They were going to run out of cash in a matter of days, maybe hours.
And the Fed feared that if Bear Stearns defaulted abruptly and chaotically, the panic would spread to every other investment bank instantly. It would be a systemic shockwave.
So, to prevent a chaotic bankruptcy, the Fed facilitated a buyout over a frantic weekend. They helped J.P. Morgan Chase acquire Bear Stearns by providing a special $30 billion loan backed by a pool of Bear's assets to absorb the most toxic parts of their balance sheet so J.P. Morgan could swallow the rest.
They saved the system from the immediate shock of a Bear Stearns collapse, but the relief was incredibly short-lived. Fast forward a few months to September 7th, the second major event. Fannie Mae and Freddie Mac.
These are the colossal government-sponsored enterprises that guaranteed half of the entire U.S. mortgage market, trillions of dollars in mortgages.
They were facing catastrophic losses from the accelerating housing crash. The government had to step in and legally place them into conservatorship, effectively nationalizing them to prevent a total catastrophic collapse of the entire housing market.
That set the stage for what is arguably the most fateful week in modern financial history. Just 1 week later, mid-September, the climax of the crisis. Lehman Brothers. Lehman was another massive investment bank, significantly bigger and more globally interconnected than Bear Stearns, and they were absolutely drowning in toxic real estate assets. But unlike Bear Stearns in March, there was no J.P. Morgan willing to swoop in and buy them. The private sector looked at Lehman's books and ran the other way.
Okay, this is the critical moment I want to press you on because this still confuses and angers a lot of people today. If the Fed moved heaven and earth using obscure laws to save Bear Stearns in March because they were terrified of contagion, why did they let Lehman Brothers go bankrupt in September?
It's the most heavily debated decision of the crisis.
Right. I mean, Bernanke knew that Lehman failing would freeze the global system. Are you saying his hands were entirely, completely tied by a technical legal statute? Couldn't they have redefined collateral in an emergency? Why let them fail and trigger the worst phase of the crash?
It's a great question, but Bernanke is unequivocal in his explanation. It comes down to the vital legal constraints of Section 13.3 and the ghost of Walter Bagehot. The Federal Reserve is a central bank, not a piggy bank or a fiscal authority. Under the law, they must lend against adequate, sound collateral.
Sound collateral.
They cannot legally just hand out taxpayer money to cover a bottomless black hole of losses. Bear Stearns, despite its problems, still had enough decent collateral to legally secure that $30 billion loan. Lehman Brothers, however, was hopelessly, deeply insolvent. The hole in their balance sheet, the massive losses on their toxic real estate, vastly exceeded the value of any collateral they left to pledge.
So they literally lacked the legal statutory authority to save them.
They couldn't lend to an insolvent institution with no collateral. It would have been illegal.
So the law forced their hand. On September 15th, Lehman files for bankruptcy. And the result was exactly the nightmare scenario everyone feared, but multiplied. Money market funds that held Lehman commercial paper suddenly realized that paper was worthless.
One major fund broke the buck,
meaning its share price dropped below the sacred $1 mark. That is supposed to be mathematically impossible for a money market fund.
When everyday investors saw that, it triggered a massive global panic. People sprinted to withdraw cash from money markets. Global credit froze solid.
But the chaos wasn't even close to over because literally the very next day, September 16th, another colossal giant is on the slab. AIG, American International Group.
AIG was a global insurance behemoth. But a specific division of AIG had essentially been operating as an unregulated hedge fund. They had written billions of dollars in credit default swaps. These were essentially unregulated insurance policies that paid out if those complex mortgage-backed securities defaulted.
Let me guess, their models told them a housing crash was impossible too.
Exactly like the rating agencies. Their models told them a national housing crash was impossible, so they collected billions in insurance premiums, but didn't hold anywhere near enough capital in reserve to actually pay out the claims if a crash happened.
And when Lehman failed and the MBS market cratered entirely, AIG was suddenly hit with billions in collateral calls and claims they physically couldn't pay. They faced immediate catastrophic collapse.
But wait. The Fed did rescue AIG.
Right. They stepped in with a massive $85 billion loan and effectively took an 80% equity stake for the government. So if Lehman was allowed to fail on Monday because they lacked collateral, why bend over backwards to save AIG on Tuesday?
Because the balance sheets were fundamentally different. AIG, despite the reckless, catastrophic derivatives trading in that one division, actually had immense sound collateral.
We did.
Yes. AIG owned massive, highly profitable, totally healthy, traditional insurance subsidiaries all over the world. Life insurance, property insurance, aircraft leasing. Those traditional businesses had real, tangible value. The Fed could legally secure its $85 billion loan against those healthy subsidiaries.
Oh, I see.
And Bernanke recognized that letting AIG collapse just 24 hours after the shock of Lehman would have completely severed the remaining arteries of the global financial system. The interconnectedness of AIG's derivatives meant their failure would bring down banks globally. The Fed made the loan, and it's worth noting that ultimately AIG repaid it in full with interest.
It is truly breathtaking to think about the weight of the decisions being made in those 48 hours, deciding the fate of global institutions. But of course, the central bank alone couldn't fix the giant toxic holes in the bank's balance sheets. The Fed can provide liquidity, but they can't provide permanent capital to cover losses. That required fiscal policy from Congress.
And we have to mention TARP here, the Troubled Asset Relief Program.
Congress authorized $700 billion. Bernanke explicitly explains in his lectures that TARP was the necessary fiscal step to recapitalize the banking sector, inject government equity directly into the banks, and absorb the massive losses that central bank loans simply couldn't cover.
TARP was the capital injection that stabilized the banking sector's solvency, while the Fed's emergency lending facilities provided the necessary liquidity to stop the runs. Together, they stopped the acute existential panic.
So what does this all mean? The panic stopped, the massive Wall Street banks weren't collapsing every weekend anymore, but the patient, the actual real-world U.S. economy, was still in a coma. Millions of jobs were lost, the stock market was in ruins, housing wealth was decimated, and the Fed was essentially out of its traditional ammunition to fight the resulting recession.
To fight the massive economic contraction, the Fed had aggressively cut the federal funds rate all the way down to a range of 0 to 25 basis points. Just to clarify the jargon, a basis point is 0.01%. So 25 basis points is 0.25%. Essentially, short-term interest rates were at 0.
And once you hit 0, you can't really cut rates anymore without venturing into negative interest rates, which is a whole different, complex, and highly disruptive territory. The Fed had hit a wall that macroeconomists call the zero lower bound.
The zero lower bound. You are at 0. You can't go lower. So your primary tool, traditional monetary policy, is effectively dead in the water.
And with the economy still rapidly shrinking and the terrifying threat of severe deflation looming, and remember, Bernanke was haunted by how deflation destroyed the economy in the 1930s, the Federal Open Market Committee had to chart completely unconventional waters. They turned to a tool they officially called large-scale asset purchases.
Which everyone in the media, on trading floors, and in textbooks just calls quantitative easing, or QE.
I want to really dig into this because I think a lot of people hear the Fed is buying bonds and their eyes just glaze over. Give me the plain English translation here. How do you stimulate the economy if interest rates are already at 0? What exactly is the mechanical process of QE?
In traditional normal times, the Fed influences short-term rates by buying short-term Treasury bills. In quantitative easing, the Fed steps into the open market and uses its unique power to create bank reserves to buy long-term assets. Specifically, they bought hundreds of billions and eventually trillions of dollars worth of long-term U.S. Treasury bonds and government-backed agency mortgage-backed securities directly from the market.
Okay, walk us through the transmission mechanism here. Why does the Fed, sitting at a computer and buying a 10-year Treasury bond from a bank, help a family in Ohio afford a car loan or refinance their mortgage?
It works through a powerful mechanism called portfolio balance effects. It is basically the fundamental law of supply and demand applied to finance. The Federal Reserve enters the bond market as a massive, relentless, price-insensitive buyer of safe, long-term bonds. By buying up so many of these bonds and holding them on the Fed's balance sheet, they drastically reduce the available supply of them in the private market.
So the supply of safe bonds goes down.
And when supply goes down while demand remains steady, what happens to the price? The price of those bonds goes up. Now, here is the crucial inverse mathematical relationship in finance. Bond prices and bond yields, the interest rate they pay to the holder, move in opposite directions. As the Fed aggressively drives the price of these safe bonds up, the yield on those bonds gets pushed down.
Ah, so the Fed is artificially forcing long-term interest rates down across the board by bidding up the price of the underlying bonds.
Precisely. And this ripples forcefully through the entire real economy. Long-term Treasury yields serve as the foundational benchmark for almost all other long-term borrowing. If the 10-year Treasury yield falls because of the Fed's buying, 30-year mortgage rates fall in tandem, auto loan rates fall, corporate bond yields fall.
Suddenly, it is drastically cheaper for a company to borrow money to build a new factory and hire workers, or for a family to refinance their mortgage at a lower rate, which puts hundreds of extra dollars in their pocket every single month to spend elsewhere in the economy, driving demand.
And there is a secondary psychological and behavioral effect for large investors. Right. If you are managing a pension fund and you are looking at these super safe government bonds, but the Fed has pushed the yield down to almost nothing, you can't meet your 7% return targets holding cash or treasuries.
You are essentially forced out of the safe haven assets. To get any kind of meaningful return on your capital, you have to move your money out along the risk spectrum. You have to start buying corporate debt, which provides essential funding to businesses. Or you have to buy equities, which drives the stock market up.
As asset prices rise across the board, Consumers who hold those assets feel wealthier. This is known as the wealth effect, and they spend more money. QE aggressively eased broad financial conditions across the entire economy when traditional rate cuts couldn't.
It is a phenomenal piece of economic engineering. And alongside QE, the Fed deployed another unconventional tool that seems almost purely psychological: forward guidance.
Forward guidance is fundamentally about communication and expectation management. Before this era, central bankers were famously cryptic. Alan Greenspan used to pride himself on mumbling so vaguely that markets couldn't interpret him.
Right.
But Bernanke realized that in a crisis, expectations dictate market behavior. So the Fed started explicitly telling the public, we're going to keep short-term interest rates near zero for a very, very long time. By making that explicit, credible promise, they anchored long-term rates. Because if a bank knows for a fact that short-term borrowing rates will be zero for the next 5 years, they're willing to offer you a much lower fixed rate on a 5-year loan today.
The result of these massive, unprecedented interventions, QE1, QE2, and eventually QE3, was that the Fed's balance sheet expanded by trillions of dollars. But more importantly, it worked. It successfully broke the deflationary psychology, stabilized asset prices, and slowly, painstakingly turned the supertanker of the U.S. economy around toward a long recovery.
It did achieve its macroeconomic goals. But as Bernanke strongly emphasizes in his lectures, emergency rescues are just that, rescues. They cure the immediate symptoms of the panic. But if you want to cure the underlying disease, if you want to prevent another 2008 from happening a decade later, you have to fundamentally overhaul the structural flaws that allowed that massive tower of unseen risk to build up in the shadow banking system in the first place. You have to rewrite the rules.
You don't just put out the fire, you rewrite the entire fire code for the city. Looking back at the regulatory failure leading up to 2007, the source material points out a critical systemic blind spot in how regulators were viewing the financial system.
The blind spot was the fundamental difference between microprudential supervision and macroprudential supervision. Before 2008, regulators were entirely obsessed with the micro. They would look at Bank A in a vacuum. Does Bank A have enough capital? Yes. Okay, they're safe. Then they look at Bank B. Is Bank B safe? Yes.
But they entirely missed the macro perspective, the systemic interconnectivity.
They didn't realize that Bank A, Bank B, and the shadow banking entities were all tied together by the exact same toxic repo market and holding the exact same CDOs.
Building on our forest fire analogy from earlier, it's like regulators checking every individual tree in the forest to make sure its leaves are green, but failing to notice that the entire forest is planted on a bed of dry, explosive kindling during a historic drought. If one tree catches fire, the health of the individual trees doesn't matter. They all go up in flames together.
To address these massive structural flaws and ensure regulators were looking at the whole forest, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. Bernanke outlines 4 major transformational shifts in the regulatory framework that came out of this legislation. The first was addressing that macroprudential blind spot directly by creating FSOC, the Financial Stability Oversight Council.
When I was reading the source material on FSOC, it struck me as a sort of financial homeland security. Before 9/11, intelligence agencies didn't talk to each other. The FBI didn't talk to the CIA. Here, you had the SEC watching securities, the Fed watching banks, and state regulators watching insurance, and none of them were sharing a unified picture. Did Dodd-Frank essentially create a unified command center?
That is an excellent comparison. FSOC brings all these disparate regulators together in one room, chaired by the Treasury Secretary, with the explicit, legally mandated task to scan the horizon for systemic risks that cross jurisdictional lines, to see the whole forest and identify the kindling before it ignites.
The second major shift targets those mega institutions that caused so much havoc: the creation of the sci-fi category.
Sci-fi stands for Systemically Important Financial Institutions. These are the giants, the very definition of too big to fail. Under Dodd-Frank, if you're designated a sci-fi, whether you are a traditional commercial bank or a massive non-bank like an insurance company or a hedge fund, you are placed under an incredibly strict regulatory microscope.
So what does that actually look like for the bank?
You are forced by law to hold much higher levels of capital as a buffer. You are subjected to strict limits on how much leverage you can use. The goal is to ensure these giants have a massive shock absorber built into their balance sheet so they can take a massive hit from the market without collapsing the broader system.
Which feeds directly into the third big shift: stress tests. I love the concept of stress tests because it sounds so brutal and unforgiving. What exactly does a Federal Reserve stress test look like for a major bank?
It is an intensely rigorous, simulated financial doomsday scenario. Every single year, the Fed designs a hypothetical severe global recession. They hand this scenario to the big banks and say, okay, imagine unemployment jumps to 10% tomorrow, commercial real estate prices crash by 40%, and the stock market loses half its value in a month. Run your current real-world balance sheet through that scenario and prove to us mathematically that you would survive.
And what if they fail?
The banks have to demonstrate they hold enough capital to absorb those hypothetical catastrophic losses and still be able to lend money to creditworthy borrowers without needing a taxpayer bailout. If they fail the test, the consequences are severe. The Fed can restrict them from paying dividends to their shareholders or legally force them to raise more capital.
It forces them to prepare for the worst when times are good, ending the complacency of the Great Moderation. But even with all that capital and all those tests, a giant complex bank could still make a fatal mistake and go under. And that was the ultimate nightmare of Lehman Brothers, the chaotic, uncontrolled bankruptcy that froze the world. Dodd-Frank tried to solve that with the fourth major provision, orderly liquidation authority.
Before Dodd-Frank, if a massive non-bank financial institution failed, the government faced a binary, horrific choice. Either use taxpayer money to bail them out, which creates moral hazard, or let them enter standard bankruptcy court, which could take years to untangle and destroy the global economy in the process, exactly like Lehman did.
Right, there was no good option.
The Orderly Liquidation Authority gives regulators a vital third path. It provides the legal power and the specific mechanism for the government to step in, take over the failing giant over a weekend, and dismantle it gracefully. Crucially, it ensures by law that the shareholders and the unsecured bondholders take the massive losses, not the taxpayers, while the core, systemically vital operations of the firm are wound down in a way that doesn't trigger a systemic panic.
It's basically the ability to execute a controlled demolition of a skyscraper, ensuring it falls into its own footprint, instead of letting it fall randomly into a crowded city and crush everything around it.
That is the perfect visualization of the policy intent.
We've covered an immense amount of ground today. We've gone from the visceral panic of 19th century bank runs through the crushing policy failures of the Great Depression, the runaway unanchored inflation of the 70s, the deceptive illusion of safety during the Great Moderation, the terrifying climax of the 2008 meltdown, and finally, the massive structural overhaul of Dodd-Frank. As we synthesize this incredible journey, looking at Bernanke's final thoughts, what are the core enduring takeaways?
Bernanke makes several profound points in his conclusion that tie all this history together. First, macroeconomic stability, meaning low unemployment and steady growth, is simply impossible without financial stability. If the underlying plumbing of the financial system is vulnerable to panics, all your other economic goals will eventually be destroyed. The two mandates are deeply, inextricably intertwined.
A huge part of achieving that stability relies on the absolute independence of the central bank. We saw it with Volcker in the 70s, bravely raising rates to 20% despite intense political hatred. We saw it with Bernanke deploying trillions of dollars in emergency lending amidst intense congressional scrutiny and public anger.
Central bank independence is paramount. If politicians who are facing a re-election campaign every 2 or 4 years controlled interest rates, they would almost always keep them artificially low to create short-term economic booms to get re-elected. That would inevitably lead to massive, runaway inflation and catastrophic busts. Insulating central bankers from short-term political pressures allows them to make the tough, historically grounded, often unpopular decisions required for long-term prosperity.
Returning to why this matters to you, the listener, understanding these levers isn't just about sounding smart at a dinner party or passing an economics exam. It is about deep financial self-defense. When you understand that interest rates dictate asset prices, when you understand that liquidity is the oxygen of the market, you can look at the economy with a sense of clarity. You can navigate your own economic life, your investments, your career choices, your debt management with courage and knowledge, rather than being swept away by the prevailing panic or euphoria of the moment.
Knowledge is the ultimate antidote to fear in financial markets.
I want to leave you with a final, somewhat provocative thought to ponder, something that builds on all of this history but looks squarely toward the future. Bernanke noted that financial panics are, at their core, a deeply human phenomenon. It is the human pendulum swinging violently from extreme leveraged greed to extreme irrational fear. As we look at the financial system being built today, an era increasingly dominated by algorithmic high-frequency trading, artificial intelligence managing trillions in assets, and decentralized finance moving at the speed of light, we have to ask ourselves, can any regulatory framework, no matter how rigorous, truly outsmart human psychology? Or are we simply using more and more advanced technology to build a faster, infinitely more complex machine for the exact same human panic to break?
That is the defining question for the next generation of central bankers and regulators.
Think back to that stale room in 2008. The central bankers managed to pull us back from the abyss because they understood history and they understood human fear. Let's hope the algorithms learn those lessons too. Keep questioning the headlines, stay curious about the forces shaping your money, and we'll catch you on the next deep dive.